All right, so welcome to the weekly meeting, newcomer trading or beginner trading session, 6:15. We're going to cover a little bit of market structure, okay? And in most of our opinion, uh, people who teach Forex, this is probably the second most important thing, right? The second most important thing you need to know about trading is the market structure. I think the first most important thing is your management of funds, right? Risk management. But this to me is the piece that if you do not understand, you're not going to have success. Okay? Uh, Market structure is the beginning and the end. If you understand it, you can make a lot of money. If you do not understand it, you're going to get beat up. And there's no other way around it. Somebody say something? Okay. So I want to pull up a chart before we watch a video. We're going to watch a video over market structure. And what I understand about market structure is everybody is not going to understand a video, right? I can recommend to you a few videos, but it's going to resonate with some of you and some of you it's not. So what I suggest is that you guys go through and you find videos that you understand, videos that make sense to you. I'm going to give you the very basics of market structure, okay? And I want you to understand that every time frame has its own structure. Does everybody understand that? A term you're going to hear many times when you talk about Forex, you're going to hear about the term called fractal. The market is fractal. The market is fractal. That means every time frame does the same thing, right? You're going to see the same thing on the weekly as you see on the 1 minute and vice versa. You can see the same thing happen over, over, and over. And I know that doesn't make sense to many of you, but if you just give it a chance and you approach this with an open mind, you'll see what I mean. So let's talk about the structure. In this piece right here, right? And we're just looking at the piece that's on this screen. I'm going to pull it. Okay. The market came from here and went to here. It pulled back and went to here. It pulled back, came here. It pulled up here. I'm not going to plot like this double because this is equal highs right here. Then the market comes to this low. Then it pulls back. Again, this is equal highs, right? So I'm not plotting all this intermediate. So this is actually a triple high. So the market comes to this point and then it goes lower. So for all intents and purposes, for this piece of market structure on the chart, it looks like this, right? So basically the market is pushing down. It did a pullback and it pushed down further, right? Because this low is lower than this low. This low is lower than this low, so on and so forth. So what I would say from this particular chart piece that I have on my page is that the market is in a downtrend. Does everybody see that?
Yeah.
Yes.
Yes.
Okay, this is very important. This is very important. When you were looking at a structure, we want to find our last swing, right? You're going to hear people talk about swing highs and swing lows, right? What is a swing high? A swing high is when the market comes from a low to a high to a higher low, and then we break that high to create the new high. All right, this new high would be the swing high, and this would be the swing low. Does everybody understand that?
Yes.
Yes.
Okay, so this is the swing low. And this is our swing high. Now, once the market pulls back, you want to see if price is going to respect this swing low. All right. When I say respect it, I mean that don't go below it. And we can clearly see that price breaks that swing low. Correct?
Yes.
Yes.
Once it breaks that swing low and pulls back, we have new swing structure. We have the swing high. We have a new swing low. Price pulls back. Price either has to challenge and break the swing high or challenge and break the swing low. In this case, it pushes down, it breaks your swing low, eventually creating a new swing low. So now, as we're pushing down, as price is pushing down, our swing structure is changing. Now this is our swing high, right?
Mm-hmm.
And we're creating a new swing low. Does that make sense?
Yes.
Yes.
Okay, this is the most difficult part this is the most challenging part in trading to most people because most people don't mark this out on their chart, right? I know I don't mark it out, and the seasoned traders don't really mark these out, but we can see it. So when a new person comes into trading, they don't mark it out on their chart, but they don't see it either. So they're going to trade a specific direction. So if you look at this, when you have this down move, every one of these candles represents a week. So during this time period of consolidation, when the market is just going back and forth, you could have traded this down, traded back up, traded down, traded back up, and a novice or a new person in trading might have got lost just trading back and forth and not paying attention to the actual structure of the market and whether or not we were expected to break this low or this high. Does that make sense? So as we're trading, we're gathering information and we're looking at our structure. Now, on a lower time frame, right? If we drop down from the weekly to the daily, it could be a totally different ballgame. So on this daily chart, I'm going to start from right here. The market went up to this high. It came down. I guess this is about equal highs. Then we broke this low. And we pulled back. Lower low, lower high, lower low, higher high, lower low, equal high, equal low,
Mm-hmm.
equal high, lower low, lower high. You see that?
Mm-hmm.
So
Yes.
on the weekly, this is swing structure. This was a swing low, swing high, then we broke the swing low. Here, the swing low was broken right here for the daily. See how the swing low was broken right here for the daily?
Mm-hmm.
The swing low wasn't broken for the weekly until down here. So once this swing low was broken for the daily, you waiting for the price to pull back so you can take a sell trade on the daily. But when you're taking this sell trade on the daily, you have to pay attention to where your swing low is because you don't have a clue that this is going to break on the daily. So the safe trade that you can take for the daily is from here to your weekly swing low. because your weekly is a higher time frame. Does that make sense? No, it doesn't.
No. Mm.
So
Okay.
Todd, so when you say your trade would have been there, so are you saying you would have bought there at that high and then sold when it broke that low?
Okay. So we're only talking about selling because this market is
Okay.
only selling.
Okay.
The only thing we can do in a bearish market is sell.
Okay.
This red line represents the weekly structure.
Mm-hmm.
The green line represents the daily structure. The higher time frame structure is always the structure that you want to respect. So in this case right here, when price went up and pulled down, right?
Mm-hmm.
And then it pulls back and sells down. When you go down to a lower time frame to catch a trade, right? So before this price pulled all the way down here, on the daily chart, you had price in this range. This was your swing low. Okay, I see it over there. Let me get it. This was your swing low originally, and this was your swing high. Correct?
Mm-hmm. Yep.
So this is where we're at.
Ah.
Let me erase the rest of these candles.
Okay.
So what I'm telling you is on the daily chart, when we see this price push up, we understand that on the weekly, we pushed up, we broke a high right here. When you
Mm-hmm.
break structure, you expect the market to pull back. Does that make sense?
Mm-hmm.
Yes.
We pushed up, we broke structure. Now we're expecting the market to pull back. We got this this double top right here. So we got a liquidity grab. We're expecting the market to sell. And this market takes off and starts selling, right?
Mm-hmm.
Y'all see that? Where
Yes.
is this sell going to? This is where most people, or most of us, I'm not going to say most people, but the way I trade, I would have put a Fibonacci on this up move. I would have measured this up move, and I would expect the pullback to come to my golden zone or my 78. And then I would have looked to get long to trade back to the top. Does that make sense?
Mm-hmm.
Okay, so here's where we have to watch structure. When this starts to sell, we get a daily bearish order block. We could have got in for this sell, and we could sell it down into our zone or into our swing area, right? We're looking for an imbalance, generally speaking, or a zone if you trade like him. Do y'all know what imbalances and zones are? Probably not.
Imbalance, not zone.
Okay, so
Yeah.
we'll discuss that later. Right now, I'm just talking about the structure. We could take this sell trade down into this area, right? We don't want to take it all the way to our swing low. We just want to sell this down into this area because it's a discounted area. If price is bullish from this level, if it's bullish from this level to this level, then what we can expect is for price to pull back to our discounted level below the 50% for we can catch a buy. So whether or not you're who's writing on the screen? Whether or not you're trading or the pullback or you're just waiting for the buy, you want to see price pull back below this 50% line before you look for a buy entry. So I would be looking for a buy entry somewhere around this area. And for me, because I've traded for so long, I would have definitely looked for a short. I would sell this down into this area because you're taking advantage of the fact that you know price is going to pull back, right? So this pullback is about 658 pips. I'm going to take advantage of a move like that because I understand what I want to see out of the market or what the market has given me. That makes sense? Once price gets to this area, then I just have to wait to see what price is going to give me. That make sense? Yay, nay?
Yeah. I
Yeah,
have a
yeah.
question
Who had a
to it.
question?
It's Marcia. So you have the red drawings. Is that daily
The
or
red
week?
drawings is the weekly. The
Oh,
green
that's the
drawings is the
weekly.
daily.
Green is, oh, okay. Gotcha.
I have a question to ask.
Yeah, what's going on?
Yeah, you sell from the premium and buy from the discount, right?
Right.
If you're making use if you're making use of the Fibonacci tool, retracement tool,
You said, am I making use of it?
like if you're making use of the Fibonacci retracement tool, you sell for the premium and buy from the discount, right?
That's correct.
Okay, that's just what I want to know.
Okay. All right. So as we get further into trading, I'll introduce you to the tools or kind of further explain them. In this particular session, I just kind of want you guys to see how the structure is laid out. Does that make sense?
Yes.
Because the
Yes.
structure piece is going to be the stumbling block for 90% of traders.
Mm.
And it's important that you understand that the time frames make a difference. On this weekly chart, we mapped the structure. It was fairly straightforward. But when we put the daily chart on, now it's a little bit more fuzzy, right?
Mm. Yes.
Mhm.
And this is how it is in real life, because the market is a living, breathing, moving mechanism, and you can catch trades from many different time frames. So some people only trade the 4 hour and below. So if we go down to the 4 hour, it's going to get even more messy. You understand what I'm saying?
Mhm.
Oh, yeah.
So this is why, in my opinion, everybody should try to learn the structure piece first, because that's the piece that's going to keep you afloat. When everything else fails, if you can go to the structure and say, okay, I see that we're in an uptrend, or I see we're in a downtrend, then you can kind of correct yourself. So I want to do a couple of more of these before we watch the video, okay?
Okay.
As a matter of fact, you know what? I'm going to watch the video and let him explain, and then we'll come back to the chart, okay?
Market structure is the central concept at the very core of pretty much every financial market. And if you're a price action trader, you need to understand everything about market structure because it directly refers to whether price is going up, down, or sideways. Without it, you're continually battling the market. And when you're fighting against the direction of the market, you're not going to have high win rates. You're going to encounter a lot of losses and you won't be able to trade with clarity. So in this class, I'm going to teach you everything that you need to know about market structure, from the very basics to some of the more intricate details that you can use in your own work. So with that said and done, let's get to the learning. So what exactly is market structure? Well, it simply refers to the trending direction of a market. And there are three different market structure phases that we need to be aware of. There are uptrends, consolidations, and downtrends. An uptrend is quite simply when the market is moving in an upward fashion. And obviously, through this phase of price action, we would only want to buy. A downtrend is, of course, the opposite, where the market is moving down. And through downtrends, we are only looking to sell. A consolidation is therefore just a range where the market is not doing a whole lot of anything, there's no clear direction, and throughout consolidation, we should just not take trades. Unless, of course, we have systems that allow us to take advantage of the liquidity in ranges. But for beginner and amateur traders, I would just focus on trading with the trend because that's where the big money's made. That's where the high probability is. So to work out which way the market is going and to actually give an objective stance to identifying uptrends, downtrends, and consolidations, we use highs and lows. An uptrend is a market where we are continually forming higher highs and higher lows. So if the market is forming higher highs and higher lows, we know the market is in an uptrend, therefore we should only look to buy. A downtrend is the opposite. It's a market that is forming lower lows and lower highs. So every low is lower than the previous, and every high is also lower than the previous. Now, quite obviously then, a consolidation is simply where the market is trading sideways and not really providing any clarity. It could be forming equal lows and equal highs, or it could be forming a higher high, followed by a lower low, followed by another higher high and another lower low. There's no direction in consolidations, therefore they're not the greatest place to trade. Every trending move in the market is made up of two different primary moves. We have impulse moves and correction moves. So an impulse is the pro-trend movement. So here in an uptrend where we're forming higher highs and higher lows, the impulses are the movements on the way to forming new higher highs, the larger moves, the reason that the market is going up. A corrective move is then the small pullback we get, because markets don't move totally linear. We're never going to see a trending market go like this. There's always going to be small pullbacks within the price action, which make it more choppy like the one that I've just covered. This is because we have control from the buyers through an impulse move. And then some buyers will take profit, sellers will start to see opportunity. The market pulls back until it reaches a level where new buyers are happy to get in, and then we get that next pro-trend movement because the buyers overtake control from the sellers and we move into new highs. So that's why that works. Now, what we want to do when we're trading is look to capitalize on the impulse moves by buying in from the bottom of corrective moves. So our job as traders is to identify where the correction is and then use other concepts to work out where the correction is going to end. And we'll cover this a little bit later in the video. Then we want to buy in from the bottom of a corrective move. So our prime buying point would be pretty much anywhere at the bottom of these higher lows. And then we can take advantage of the impulse move for either a small trade or a larger pro-trend trade that we expect to hold for a longer time span. Now, for a selling phase in the market, things are pretty much exactly the same. So instead of having higher highs and lower lows, what we would have is a lower low, lower high, lower low, lower high. Now, these pro-trend downward movements are the impulsive moves, the large moves that form the reason that the market is going down. So these are the structural moves that are able to break past the previous lower lows and lead into continued downside. That is the impulsive move. Now, the correction or the corrective move is then going to be the small upward pullback that forms the lower high in the market. So whichever way we're going, we have impulses as the pro-trend movements and corrections as the smaller pullback movements. And this builds the foundation for the work that you're going to be doing with structure because we want to work with the trend. We can use the higher highs, higher lows, lower highs, and lower lows to identify which way a market's going. Then we can work out the impulsive and corrective moves. Now we have a solid foundation to start working off to actually start nailing some great trades. Now there's a question I want to answer before you even start asking it. And that is, why should we use raw price action structure over things like trend lines? Trend lines are easy to identify because we just connect some highs. We can get that done faster. Well, we're going to go through a real example here. This is a trend line, a downward trend line. So this is supposed to indicate a downtrend in price. So we can see we connected one high to another, and this is supposed to indicate the trend. So the concept then is every time the market retests this level, it should be moving into a new selling move. And if it doesn't, and it instead breaks upwards, that indicates a change in the trend. So when we see price action like this occurring, where we've broken above the trend line traders now see this as a trend reversal. And they will now look for a pullback and buying opportunity because they think that the market has changed direction, which is an easy mistake to make if you're trusting in trend lines. Now, I just want to give you about 5 to 10 seconds to review this structure. If you look at it from a lower low and lower high perspective, has the structure actually changed like the trend line suggests? Well, the answer is no. The structure hasn't actually changed. So we have the high here. Then we had a break of structure, which led us into a lower low. Then we had a lower high. Then we had another break of structure, which led us into a lower low. Then we had another lower high. Now we've come down and formed another lower low. If we take a look at where the price is now, it's below the previous lower high. So we haven't actually changed the structure at all. All that's happened is this imaginary line that you've drawn on the chart has broken. But in reality, the market is still moving in a clear phase of lower lows and lower highs. So if you were a trend line buyer and you tried to buy from here, you're going to lose because the market is still downtrending and you are therefore battling the trend. Now, if instead we did manage to get up and break this high, that would validate a change in the trend. And then you could go ahead and find opportunities to buy the other way because the market has broken out of its lower low, lower high phase and pushed instead into a higher high and higher low phase. But until that structural point there breaks, the real price structure, this trend line means nothing, and this is still a bearish market. Now let me highlight what happens when we focus on trend lines over structure. Instead of winning your buy trade, you are very much likely to lose because you are fighting the trend. So from a trend line perspective, this looked like a viable buy, you would have lost. From a structure perspective, what do we have instead? Well, this formation of a lower low on this corrective move could have provided an opportunity for us to sell when we pair it with some other concepts. Therefore, we could have taken a profitable selling move here, so you could make potentially 3, 4, or 5% while the trendline trader is losing. Now, one thing that people get stuck with structure is looking at every single little intricate move and getting confused. So we're looking at a market here which is in a downtrend, and then at the end shifts into an uptrend. We'll go through this as we go along, but what people will do is look at every single tiny little movement in the structure and treat that as significant structural breaks. So as you can see, I'm marking the price action up pretty much from candle to candle. This is how people look at structure, then they get incredibly confused. Now that's totally fine, it's understandable. People are going to view structure this way, especially when you're first getting into the concept. But what I want to do to simplify your work, and this will take some practice from your side, but eventually you'll start to really understand how to do this, and it will become very, very simple to you, is to view structure as waves. So rather than viewing every single candle movement, we want to kind of zoom out and get a broad overview of the market. So in this market, which we can see is continually making these lower lows and lower highs, we would identify the structure in the format of waves. So we have this high, we can pull that down to this low, then we have the pullback to this point, then we have a new lower low, then we have a new lower high, and then we have the new lower low all the way down here. We have a lower high, and then we have a new lower low. So let me explain how I've come to the conclusion here to mark the structure in this way. We can see this is a clear viable high. Then we have a clear viable low. Then we have the pullback forming a lower high. Then we come down in this clear movement and form a lower low. Then we have the lower high. Then we have the lower low. So although there's all this smaller structure within, and this will become relevant soon, don't worry, we don't need to consider every single small movement as a structural break. Because when we look at the higher time frame picture here, it's not. These small movements don't actually change the larger structure in any way because they are still confined within the range from the previous lower high to the previous lower low. So any structure that takes place here, yes, can be a valid trend and yes, can be traded. And this is called substructure, which we're going to get into soon. It shouldn't actually affect your view of the larger trend. Because if we consider this, even if this was a small uptrend, it didn't break past the previous lower high, meaning the market on a big picture perspective is still in a downtrend. So when we can start to view structure as waves in this manner, instead of pulling ourselves into every single tiny little movement that forms in the market, structure becomes a lot clearer and easier to understand. And as I say, it's going to take some practice, but you will get used to doing this and viewing the structure as larger waves. Some people nail it right away. Some people will find some confusion. But like all concepts, practice will make you a lot better. So now let's go a little bit deeper into that concept of substructure. And I'll show you the two different formats of structure, which are swing structure and substructure, and how we can trade them successfully without getting confused. Market structure is a fractal concept, and that means the same price structure movements are going to occur on a very low time frame and also on a very high time frame. So you can look at the daily time frame, you can look at the 1 minute time frame, you'll see these same tendencies in the structure of the market. Now, because of this, within every larger trend, we also have smaller trends, and this creates swing structure and substructure. So let's take a look at this example. Now imagine this larger black line, which indicates the swing structure or the overall higher time frame trend of the market is, let's say, the 4 hour time frame. Well, then within that, every upward move we have on the 4 hour and every downward move we have on the 4 hour can also form hourly, 30 minute and 15 minute trends within. And this actually continually dials down. So then if we looked within the 30 minute trend, we would then see smaller 5 minute and 10 minute trends within. If we then looked at the 5 minute trend, there would be smaller 1 minute and 30-second trends within that. So no matter what time frame you're looking at, there's going to be a smaller version of new trends inside of that price action. And that is where the concept of the swing structure and substructure comes in. So substructure simply refers to the smaller trends happening within the swing structure movement. So if you're a trader who uses the daily, the 4 hour, and the 1 hour, well, then the daily is going to have smaller 4 hour and 1 hour trends within it, and so on. Now, there's one core way that we can take advantage of substructure. And the substructure that we ideally want to be trading is the substructure that takes place during the corrections or the corrective moves. So remember before we said the pro-trend movements are impulses, the pullback moves are corrections. When we're trading the pro-trend movements, it makes the most sense to just trade the swing structure. Trade the higher time frame, move with the higher time frame trend. But the pullbacks that we get, the corrective moves, actually provide smaller trends and generally provide new trading opportunities that we can capitalize upon if we understand and use this concept of substructure. So I've marked out these areas. This is ideally where the substructure will become useful to you, the pullback movements, and this is where the substructure trades become available. So the way that we would do this is when we're looking at a higher time frame trend, obviously that's going to be rather linear, just moving to the upside. But if we go to a lower time frame, so now focus on this green line, what we will actually start to see is smaller trends and trend reversals taking place within. And really quick, guys, identifying a reversal is rather simple. We are looking for phases in the market where we shift from higher highs and higher lows into lower lows and lower highs. This change in the trend validates a reversal because it tells us that the market is no longer continuing with the impulsive pushes to the upside and is instead now impulsing to the downside. And that's a reversal from a bullish into a bearish trend. So that's the point where we would stop buying and instead start to sell. Now, if we were looking on the other side at the end of a downtrend to validate a change from the downtrend into an uptrend, we would look for a break from lower highs into higher highs. And then when the market forms and validates a higher low, that is where we would look to then start buying instead of selling. Now, after we see one of these lower time frame trend reversals, we would actually see opportunity to start selling through the substructure move. So if we're following a 4-hour uptrend, we might find a 30-minute opportunity to sell short term on the way down towards a more meaningful area in the swing structure. Then we can close our trade and look to continue with the swing structure once we start to see the market structure breaking. Then if we see the same thing again, where a lower time frame is starting to break into a downtrend, we may have an opportunity to trade through some substructure before the swing structure movement continues. So really, we can have one larger trade working through the swing structure, or a few trades where we're buying at the lows of each of the swing structural movements. But then within that, we can also find conflicting opportunities that will work for day trades, which are going to be these substructure pullbacks, which may provide lower time frame selling opportunities for us to take throughout the day while we wait for the swing structure to form enough strength for its next move. So now let's take a look at an example of the swing and substructure in action. Now here we are looking at GBP USD on the 4-hour time frame. And we can see quite visibly, if we consider the highs and lows, we have the high, then we have this low, which has broken structure here, making a lower low. Then we have a lower high, then we came down and we formed this lower low after breaking the structure just there. So viewing the structure in waves as we do, we can see we have the high, lower high, lower low. So we are in a confirmed downtrend. And the swing highs of the swing structure points would be, first of all, there, second of all, here. So in order to change the trend direction, in order to start getting into buys, we need to see this high break, because we need the market to impulse into a new trend. At the moment, the impulses are pointing to the downside, so there is absolutely no reason why we should expect the market to do this, until, of course, and unless, of course, we break that structural point. Now, as you are also going to see, though, throughout the corrective moves, such as this one here, we have this smaller uptrend. So you can see the opportunities arise within these smaller moves. Now, we can actually buy through corrective movements if we have the right confirmations to do so, with the understanding and the rule that we should not look to take price further than the swing structure high. So let's dial in on this current example here. If we were looking at this trending structure, we have the swing structure move to the downside, but if the market structure shifted, we could potentially take a buy. However, any buy that we do take should only look to lead at a maximum up to this high and below this high. Because at the moment, with the swing structure still pointing to the downside, this high is going to hold significance. And unless this high breaks, we shouldn't look to buy past that point because it would be unconfirmed, and then we would be fighting the trend. So we can buy into an uptrend if we get one forming on the lower time frames, but at most, we should look to target kind of high probability areas below this high, okay? Now, I trade using supply and demand. I'll put a card in the top of the video breaking down supply and demand if you want to go and watch a class on that. The supply and demand zones are essentially just zones where we've seen large amounts of selling or buying previously. A supply zone would look like this, where we mark the last candle before the impulse down. This is an area where lots of selling took place before, so the concept is when the market gets back to this point, it's likely to start selling again. So what does this do? Well, this provides us with an idea that this could act as a magnet for price, and this is where the next movement could come from. So if we were looking to continue the swing structure, our trade idea would be simple: sell from this supply. So when the market pulls into that area, we would place a sell order with a stop loss above the high and look to trade into a new impulsive leg of downward movement to continue the existing downtrend. And from a swing structure perspective, that means if structure allowed us to on a lower time frame, such as the hourly, we could buy towards that supply and use that supply zone as a target to then get out of positions on the buy side and lead into those positions on the sell side. So, providing the market gave us what we wanted to see in order to execute a trade here, we could buy through this substructure, and that is what provides these smaller trades. So as we can see now that we're on the hourly, we have indeed actually had a break of the structure just here. So we have this lower low structure forming and lower high structure forming on the lower time frames, and then we broke above the structure just here. So what we could do at this point is look for, once again, supply and demand. This time I'd be looking for demand, which is the last candle before this impulsive move to the upside. We would place a buy order just in this zone, and then we would position stops below, and we would use that higher time frame supply as a target. And now this would become a viable trade for us to actually take the market higher before leading into larger shorts. So we formulated two ideas. We have the swing structure move, which would be a sell from this zone, stop losses above, looking to trade into new low price. And we have this smaller idea taking advantage of this lower time frame structure to buy through the smaller range, targeting this area. Remembering that we can only look to trade within the swing structure range. We can't look to extend this trade further than that because the impulsive movements are telling us that the market is trending down. So now if we allow this market to play out, you see, we get the trade through that substructure before filling the swing structure trade and moving to the downside. Now, obviously, these are very loose examples, but I'm presenting you with what you can actually start to do. And a lot of the trades that I take actually take place within this substructure. And the great thing about the swing and substructure style of trading is that you always have the high time frame picture and the big picture narrative in mind. The higher time frames are almost always the most accurate time frames to be trading. So when we build our picture around those high time frames and then use these lower time frames to scale into our positions, we have high probability and a lot of clarity around what the market is doing. Before we finish up with today's class, I want to give you a very important tip, and that is validating reversals with body closures versus wicks. So before we spoke about how a shift in the trend or a reversal in the trend takes place when we shift from higher highs and higher lows into lower lows and lower highs, or vice versa if we're going from a downtrend into an uptrend. Now, one very important thing to note is that wicks do not indicate a break in the trend. Now, we have something called liquidity and liquidations that take place in the market. If you want to learn more about liquidity, card somewhere in the top video as well as in the description for a class on that. But basically, not every time that we break a structural point will the market continue into reversals. Sometimes the market will sweep a low, as we can see here, and then instead of reversing, actually go back up and make new highs in the trend. Now, in essence, what wicks are showing us is a rejection of momentum. So in this selling move, we have this higher low. We had a break here, which some people would see as a break in structure and start selling into, thinking this market is reversing. But if we consider what wicks show, they show rejected prices. So this shows the market attempted to reverse, but failed because we closed back above. In order to validate a reversal here, we would need to see candle body closures below this level. If we got a candle body closure, that would tell us the market is confirming a reversal. But this, with the wicks, is telling us we are rejecting a reversal. But let's just take a look at how the market played out here. You will see that instead of moving to the downside, we actually pushed up and made totally new highs in the trend. That's because we rejected the reversal with wicks. So remember, to validate a reversal, you need to see candle body closures. Wicks will not cut it because they're actually showing the opposite. They're showing a rejection of lower prices, which is generally going to lead into just continuations of further upside. So there you have it. There's pretty much everything you need to know about.
Yeah. All right, you guys have any questions?
So,
Sorry. Go ahead.
okay, thank you. So far as reversals, signs of reversals would be, he said, when you see wicks at that level.
Okay. So that's exactly what he said. But what does
Oh.
that mean to you?
The market is going the opposite way. The market will start going the opposite way to create higher, well, if it's in the opposite way. I can't get with the higher highs and higher lows and
Okay.
lower highs. I'm still trying to get that
So
terminology.
let's talk about it.
That's exactly what I wanted to ask. The last part, what he was talking about, like the candle has to look like what
So let's
to
talk
come
about it.
to reversal? Thank you.
Y'all see this trend on this weekly chart. It's clearly a downtrend, correct?
Yes.
Okay.
Yeah.
So when you trade, you're going to use at least two different time frames. You're going to use one time frame for your setup and one time frame for your entry.
Mm-hmm.
So if I clearly see that this is a downtrend, then what I'm looking for is for a lower time frame to give me the opportunity to get into one of these down moves, right? So
Mm-hmm.
see how price came up and we have a wick rejection.
Mm-hmm.
We rejected at this high. We rejected, right? If we go down to a lower time frame, let me highlight this. If I go to the I don't think it's going to allow me to do it. Okay, if I go to the 4-hour chart, you see where the highlighted area is?
Mm-hmm.
This was the
Yes.
high. So what he's saying is you want to see price close above this area. This is an area we call imbalance. Maybe some of you guys know what an imbalance is. You had a 4-hour bearish movement down, you left imbalance. Price came back up, filled this imbalance with rejection, not with full candles, and then price pushed down. So if you were a person who understood that this was a pullback to that weekly sales swing, then when you see these rejections in this imbalance, you're going to be looking to get short to take the next leg of that trade down. Does that make sense?
Okay. Okay. So that area is where the rejection kept happening,
Yes.
where the imbalance is.
Yeah. So you see how the market came down to this area,
Mm-hmm.
pulled back, filled this
Mm-hmm.
imbalance, pushed
Mm-hmm.
down, broke this structure on this 4-hour time frame where we broke structure right here. We left an
Yep.
imbalance. The market came right back to that same area, right? And wicked
Mm-hmm.
out to
Mm-hmm.
go further down. Now, if you understand structure,
Oh.
you
Todd, I got a question real quick. I'm sorry. Um, I see the imbalance. I know the candle there, nothing else was there. But can you just go a little bit into what actually shows the rejection? How do I spot that rejection?
a rejection is the candle wicks out. Okay,
Okay.
on this 4-hour candle,
Mm-hmm.
you have a strong bullish candle, then you have this wick, which means rejection. Then you get a strong bullish candle, it's a full candle.
Mm-hmm.
Then you get wick at the bottom, and then wick at the top.
Mm-hmm.
Wick at the top. Now this candle closed forward. That's rejection.
Okay.
The wicks show you, hey man, I'm trying to go up or I'm trying to go down, but price is
Ah.
pushing me back in the opposite direction.
Mm-hmm. Mm-hmm. Okay.
And when you get the rejection at your key levels, you'll hear
Mm.
many traders, Kim says it all the time, I'll say it at a key level. Well, what is a key level? The key level I just showed you was This was where the break of structure was, right?
Mm-hmm.
Where we
Mm-hmm.
broke structure, we have an imbalance. Once this imbalance is filled, I'm looking for price to continue to sell. So I have this imbalance marked out. This market comes to my key level and rejects.
Okay. Mm-hmm. Okay.
So it's on and popping. You get in and you sell it from there. That's really, what you need to understand about structure, right? You're going to have key levels. You're going to have discount and premium pricing. And depending on who's saying it, you're going to understand it better or you're not going to understand it enough, right?
Mm-hmm.
So the main thing here is to be able to map out your structure. If I can map this structure out on this weekly time frame, I understand on this weekly chart we're on a downtrend. Okay. I listened back to the video call from yesterday that Kim did,
Mm-hmm.
and it was a lot of frustration on my part because Kim and Kenya's conversation when it comes to this particular situation. And I believe they started on this 2-month time frame, right? And what I wish that would have been said during that meeting yesterday was, it doesn't matter what time frame you're on, right? Like a lot of people say, "Oh man, I don't look at the 2-month time frame." It doesn't matter. It's all the same. If you look at this 2-month time frame, it's still it's bullish structure, right? Price is pushing up. Once price pushed up to this same level that we got all this rejection from, any other time price has been up, it's always rejected the same area, right?
Mm-hmm.
Y'all see that?
Yep.
This year is January 2016. Price rejected. Price came back up here. March 2020. The pandemic rejected. Price came up here January this year and rejected. So to me, where is it rejecting to, right? We broke structure. We broke this. Can y'all see how these were highs right here and this price broke out? We broke
Mm-hmm.
Price is just pulling down into this institutional candle. This is a demand zone, right? That's what he just said.
Mm-hmm.
Price is pulling in that demand zone, and you're going to get a buy from there. Now, is it going to go to these highs? Maybe not. It might just go 200 pips up to sell further. But the point is, you're going to get a buy from this zone
Mm-hmm.
because you can see the structure. Now, if I take the ones that we drew, the structure that we drew up here. Hold on, let me see if I can move this. If I remove our structure, for those of you who have been trading for a little bit, I could point out and say, hey, price is probably going to buy from your zone, come back to this imbalance to keep selling. You see how I got that? You see
Can
how
you do that again?
you see this imbalance?
Mm-hmm.
Does everybody know what an imbalance is?
Yes.
The wick of this candle needs to have a relationship with the wick of this candle. And since they don't, the area that's void of those wicks is called an imbalance. All we have is a big red candle. The market was only offered to sellers. So buying needs to happen. We need to buy into this imbalance. So I expect for price to hit this zone and buy back up into that area.
Oh,
Huh?
so an imbalance, is that somewhat similar to a fair value gap?
It's the exact same thing.
Okay. Okay.
So imbalance, fair value gap, gap in price, all of that.
Mm-hmm. Perfect.
And you'll trade it the exact same way. So
Okay.
Can I just ask something? Are you beginner, Marcia, in trading?
Hmm.
I am.
Yes,
I
you
just
are.
I started 4 years ago as a signals taker and I picked up on some things. I never knew structure. So
Okay, no,
this structure, mhm.
because at some points I have a feeling it's going really fast for the beginners.
No, 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 no. So that's where you have to ask questions. Um, if you're a beginner and you don't understand something, you have to ask questions. Guys, this is a free FREE Forex course.
Yeah.
I'm not hiding anything from you. But if you don't ask, I will not know that you're missing something.
Yeah.
So
No, right now with the imbalance, that was good that you explained because I understand Marcia understands what that is, but the other beginners, they probably don't know what imbalance is.
right. So if you don't, if that's why I said, does everybody understand what an imbalance is? And I really need, and that's you bring up a good point because many
Yeah.
times people will come on these calls and say, I don't want to ask a question. I don't want to sound dumb. Bruh, that's like
Yeah.
a first grader saying, I don't want to ask questions. I don't want to sound dumb. You're in the first grade.
Yeah.
You're supposed to be dumb. Like you're not, you don't know anything. So we all have to ask, guys, I'm not here judging anybody. I'm here pouring out my soul because I want you guys to become rich. Or
Yes.
even if you're not rich, I want you to become self-sufficient, not depending on Uncle Sam or anybody at a job that can say, hey, you know what? I don't need your services anymore. I want you to be able to pull money out of the market to be able to eat on a daily basis, to be able to
Yes.
homeschool your children, to be able to live
Yes.
in places that don't cost crazy amounts of money and treat us horrible. So please, 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 please ask any questions that you don't understand, especially if we're in a subject matter that's brand new to you. We all understand that we learn differently and we learn better from other people. It's the reason why I use videos because I'm not naive enough to think that A, I'm the best instructor, or B, that everybody is going to learn the way that I teach. So if you're missing something or if you don't understand something, please stop me from going further until we get clarification on the subject matter we're talking about. Okay? Can I please get you guys to at least agree to that?
Yes.
Okay, awesome.
Yes. Yes.
Okay, so that with that being said, can you clarify a little bit more for me, like in layman terms? Like I get it, but I get the question I'm going to ask. So I kind of know what it means, but I want to know what it means when I look at the chart, what it's saying, and that is the bullish and bearish market. Like I get it, the supply and demand, I kind of get it, but I want to get it and know, like I'm looking at the chart, I'm looking at a bullish, I'm looking at a bear. What shows me that
Okay.
this is when you buy, this is when you sell.
Okay. So I'm going to go back to this weekly because it's easier.
Okay.
So bullish means buying, bearish means selling. Okay.
Mhm.
So just for everybody's understanding, I'm going to go back and grab that path tool so I can kind of mark this up the way that I see it. Okay. So remember the guy was saying, hey, I want y'all to find the high. I'm going to mark the highs and lows, right?
Yes. Mhm.
So if you follow me along here, even if you would have marked it differently, this is how I see this price action, right? So
Mhm.
on this green leg, this is where price was buying, right? This was a high, this is a low, higher, higher low, higher, higher low, higher high. Would you agree with that?
Yes.
Now, you asked me how did we know that price is either buying or selling, right?
Yes.
I'm going to show you, and I'm going to change this color to red. So when we're buying, we're breaking highs, right?
Mhm.
Now, at this point, we break the high. But now we come back and we break that low. Notice over here, none of these lows have been broken.
Right. Okay. Mm-hmm.
The minute we come back and break the low on this time frame, that's telling you as a trader, hey, we're not going higher, we're going lower.
Mm-hmm.
Right? So
Mm-hmm.
now when this price pulls back, you're looking to get in for the sell. So
Okay.
the question you should be asking is, how far back is this going to pull? And this is where your premium and discount comes in, right?
Right.
You want this price to pull back at least 50% of this leg down. And generally speaking, if I drop to a 4-hour time frame, I'm going to
Mhm.
see an imbalance. I'm just going to do this. And again, we'll get into this further, guys.
Mm-hmm.
This is not the last time you're going to hear about imbalance or this Fibonacci, but I'm not going to talk about the Fibonacci at this point. But I'm just going to show you how I would use it. If you notice, the market is coming down here, right?
Mm-hmm.
Now, all these candles have relationships. This candle wick, let me make it bigger because this is kind of small. All right, you see the wick, the bottom wick of this candle?
Yes.
If I
Mm-hmm.
go over, it touches the top wick of this third candle.
Mm-hmm.
Bottom wick of this candle, if I go over, does not touch the top wick of this candle.
Right. Mm-hmm.
So this is called an imbalance, right? And even
Yes.
when this price goes up this high, it doesn't touch this wick. So if I highlight that area, if I put a box around this area,
Mm-hmm.
this is where I expect the market to come back to, and I could be able to take a sell trade from this area right here. Does that make sense?
Yes.
Okay. Now I'm just going to squeeze this in.
Sorry, can I just confirm that's where the imbalance is?
Yes, that's the imbalance.
Yeah.
That is the imbalance from the high of this candle wick to the low of this candle wick. And look where this market comes back to. Boom. It would have put me in the trade for the sell. I would have made a lot of money. You see that? Do you guys understand that?
Yes.
Yes.
Now,
Yep.
again, eventually we will actually talk about the Fibonacci and all that stuff. But I don't want to take the lesson to the Fibonacci. But you see how I identified an area that I wanted to see this market pull back to before I sell it further. And you see how the market pulled right back to that area, right? Everybody see that?
Yep.
Yeah.
So
Yeah.
that's the important thing. The question was, how do I mark, or how do I know if it's bullish or bearish? Did everybody understand the question? How do you know if this market is bullish or bearish? It's bullish if we're breaking highs. This was a high. We broke that high. Here's a new low. We broke that high. Here's a new low. We broke that high. Now the bearish part, because we came back and broke this low, we pull back to the area that I've identified. I get in for the sell, and we break this low. We pull back. We break another low, right? And now, because we're at the bottom of this structure, I would get out of my sell around this area. Push down a little bit more, but I'm going to get out of my sell once price hits this yellow area, because that's the bottom of the zone. The zone pushed up and pulled back. So now I'm expecting that price is going to start pushing back up again. But we will talk about that further as we get further along in these lessons. Does that make sense?
Yeah.
So who does not understand how to recognize whether the market is buying or selling? Now, I'm a swing trader. So generally speaking, I'm going to speak to you from at least the weekly time frame. All right. I believe you can make a great deal of money by using and understanding the weekly time frame, right? I'm assuming that everybody has a job and everybody gets paid. It takes you at least a week to get paid. I'm just going to assume that. Uh, if you use this weekly chart, you can do the same thing with the weekly chart, just like you get paid with your job. All right. So is anybody confused about how to see a bearish or a bullish trend in the market? Everybody's good.
Mhm.
Okay. Is anybody confused on market structure?
No.
Are we sure?
It's a lot, yeah.
So you know what's the difference between a higher high and a swing high?
This is one thing I wanted to ask, actually, the swing high. That's when it breaks or whatever, like the last high.
What's that?
So the swing high is when it, how do I say that? Like breaks the last high, like swing high,
Okay.
or how do you say it? Like
So you're correct. However, I think there's a better way to explain it. So when we talk about swing structure, right? When this market is going up, it comes from this low to this high and it pulls back. This is the swing structure, right? This up move and pullback is the swing structure. Now, the next swing, it pushes up and it breaks this swing high. This becomes the new swing low. And here's your new swing structure, right?
Upside.
Does everybody understand that?
Hey, Todd, so a swing high would be pretty much everything together once you've identified that higher high.
Okay.
The upside.
So the technical definition of a swing high uh, is it's a high that's a swing high is established once we break an old swing high. For instance, this was a swing high, we pulled back. Since we broke this old swing high, you have a new swing high established. And the low that caused that break is the new swing low. But here's a better way to look at it. If you're just looking at one time frame, right? Every move, you're going to say this is a low, right? And this would be a high. That's your swing high and that's your swing low for all intents and purposes. It's the same thing. This right here is a lower, I'm sorry, a higher low.
Higher low.
And then you have a higher high. Okay, so it's still your swing structure, but your swing structure is not really important until you include another time frame. Because of course we all see where the high and the low is on this particular time frame, right?
Mm-hmm.
So really, if you ask me, the important piece of swing structure comes in when you're adding another layer of structure, like another time frame. Then it becomes important to understand where your swing structure is. Because let me see. If I was labeling this just like this is how I would label it. I would label a low, a high, a higher low, higher high, higher low, higher high. But that's important to me because we're on the weekly chart. Now, if I wanted to go down here and actually make trades, if I'm taking trades on this weekly chart in this upward direction, then I need to use a lower time frame to give me an entry into a trade to go further and further up. Does that make sense? So I would have to use a 4-hour. And when I drop down to the 4-hour, it's a lot different. So this is that same low, right? And this is that same high. So I would want to see the market pull back before I get in for a buy going further up. Does that make sense? So once the market gets here, I need the market to pull back to let me in a trade to go further up. And once it gets here, I need to pull back to let me in a trade. I would have wanted the market to pull back to this area to go higher, which it never did. So I would not have gotten in this trade. I would have been looking at this low. We broke this high. I needed to pull back. It never pulled back. So on this time frame, I couldn't have gotten an entry into this trade. Maybe around this area, I could have found an entry because I can find from this low, we broke these highs and the market pulled back. That's probably a discounted level. See, the market comes back into your discounted area.
Mm-hmm.
So I can get a buy from here to go up.
Okay.
But this would have been basically the only time that I could have got in for a buy. This movement is so strong that it didn't give you an opportunity to get in for a buy at the lower time frames because every time it broke a high, it never pulled back. You don't want to buy at the top of the market. So when you break a high, if you're in a bull market, you expect the market to pull back to let you in to go higher. You break a high. When you broke this high, you expected the market to pull back. It did. So probably from here to here is a good pullback. And then from here, when you broke these highs to here is a good pullback. But the rest of that, you could not have gotten in this trade unless you had gotten in down here at your demand zone. You wouldn't have gotten in this trade until you see this move up and this pullback. That would have let you in, and then this move up and this pullback would have let you in. This move up here, breaking this high and pull back. So you probably could have got 3 entries close in close proximity or closer proximity than this move, and you could have taken those up. Now, once the market got here, this level, see these lows right here? You don't want the market to come back and break those lows because that's telling you that swing high has been broken. These higher highs, these H's up here, this is your swing structure. And these L's are your swing lows. Does that make sense? So on the weekly, this is your weekly swing high. This is your weekly swing low. So if price pushes down and breaks your swing low, you see how that price is coming down? Once price breaks your swing low, you're like, oh man, I have a good trading opportunity because I'll be able to catch a trade, from this level to at least sell to this swing low because we broke this swing low already. So now I can catch a trade. If I catch it up here, I can sell it to this swing low, which is how many pips? 618 pips. Y'all quiet, so that tells me y'all don't understand. Because we broke this swing low, we know the market is selling. Y'all get?
Yes, I
Everybody
got
agree?
it.
Okay.
Yeah, that's called a change of character. This market comes from this high and breaks this low right here. That's called a change of character. All we're waiting for is a pullback to our key area.
Okay.
To the downside.
Short. We take a short. We're going to challenge the next swing low. So I can take this short and challenge this next swing low. So I'm going to go over here and look. If you're trading like Kim, she's going to tell you to look for the last down candle, that red candle right there before the up move, right? Have y'all talked to Kim about that yet? Institutional candles?
No.
Okay. What Kim would tell you is this is my zone. It's the last down candle before the up move. I know she gonna talk trash about the way I do her voice, but she's gonna look for price to come to that zone, right? If it were me telling you to trade, I'm gonna say, hey, we're gonna look for either these equal lows or an order block, right? Which would have been right around this zone for you to take that price to. But you're targeting that swing low because price has told you that we're selling that. And I showed you already how we would have picked this area, that imbalance right there. I showed you how I would have looked for that imbalance. We would have gotten the trade. Y'all see that, right?
Mm-hmm.
Then it would just been a matter of waiting until price got to your area down here. Let me see the short.
Can you show an order block?
Yeah, I'll show you an order block here in a minute.
So are you talking about some advanced trading now? You talking about order blocks?
Yeah, I mean we're gonna learn about all that. We got to learn structure first, but
Right.
it's all relevant. You guys will see. Okay, finally it hit our TP. Y'all see that?
Yep.
It took a while, but it finally got to our area. And we would have got our 572 pips or whatever pip count. Okay. That's just based off of structure because the signal for us to sell was the break of this swing low.
Mm-hmm.
Right? Then it pulled back to the area that we saw how to go in and look for our area of interest, and price came right back there to let us in the trade. And then it took a while, but it finally dropped down and it paid us. That's all trading is.
Okay.
Now, as far as order blocks, supply and demand, all those are cute names, and they all say the same thing, right? All we're trying to do is find out where price is coming from and where price is going. And we don't always have to be 100% accurate, but it gives us an opportunity to take part in the trade. So let's go look at order blocks. Doesn't matter what time frame. I'm gonna use a super high time frame because I want them to be big and clear. Okay. All right. So if you're trading like me, or you're looking at markets like me, anytime the market goes up, you want to look for a bullish order block. And anytime the market goes down, you want to look for a bearish order block. So if we start over here, way over here, right? You see how this market comes up and it gets to the top, and you have this red candle that's longer than this green candle?
Yeah.
That's what we call a bearish order block, right? See how this red candle is longer than that green candle?
Yeah.
Another bearish order block. If you can find these types of candles, it's going to make your trading 1,000 times easier, right? You see how this market comes here and it goes up? You see how you got the little red candle and a bigger green candle?
Mm-hmm.
That's a bullish order block. So if you trade from those order blocks, then it's giving you the direction, right? You got a small red candle, a larger green candle. That's the signal that the market is going to go up. If you got a small green candle and a larger red candle, it's a signal that the market is going to go down. Does that make sense?
Yes, it does.
And those are order blocks, right? Now, many people will have different definitions, but if you stick to what I just showed you, if you stick to what I just showed you, and you learn that the way I just showed you, you will definitely have a better time trading.
Okay.
All right. I see a question about, does the market travel from imbalance to imbalance? Okay. Let's talk about that. And this is, if you have a notebook, you can write this down. All right. If you find, to me, there are three things you need for a good trade setup, right? You need a order block, right? That order block will create an imbalance. You see how there's no wick on the bottom of this green candle? And then the top wick of this red candle does not touch that candle.
Yeah.
It's an imbalance. So you have a bearish order block here,
Can
right?
I just ask, does imbalance always shows like this?
Yeah,
Okay.
yeah. It's always going to be the same thing. You have an order block here, you have an imbalance.
Yeah.
And if you get a break of structure, right? Like we break these lows. If you have those three things, you have a great setup. You just wait for price to trade back into your imbalance, put your stop loss above that candle, and you would have caught a sell trade.
Mm.
You can take this trade back to these lows. You'd have got in here, and eventually you would have got paid here. This, you have an order block. You have a little red candle and a bigger red candle, right? There's an imbalance. We broke structure. Price buy back up into this imbalance. Now you can sell it. It's always the same setup, the same situation. Once you see it, you won't be able to unsee it, right? And I'm not saying you're going to win every trade, but you're going to have a degree of consistency, a level of consistency that many people never have.
Mm.
And if you go and you look at these markets, it doesn't matter what time frame, it doesn't matter what pair, right? If I look up here, I have a bearish order block, I have an imbalance, I have a break of structure. The market just has never came back up into this level. But once it does, it's going to sell from there. The market comes down, you got a bearish order block. You see that little green candle? You see this bigger red candle?
Yeah.
You see that imbalance right there?
Yeah.
And we broke the structure down here. The market comes right back up into that imbalance and sells. You know, never mind the fact that these are 2-month candles, but the science behind what's going on in the market is the same. You got the order block, you have an imbalance, you have a break of structure. The market trades back into that imbalance, and then it drops. If you go back and you look at what's going on in these markets, order block, imbalance, there's two imbalances. There's the break of structure. The market trades back up into this lower imbalance, and it sells eventually, right? We never break the high of that candle. It might have took a long time, but it never broke the high of that candle, and it sold. You would have hit these. Your TP was this low right here. You'd have hit it eventually. If you understand this very thing about the market, you can make a lot of money, right? But it requires consistency. Consistency is what you have to give the market. If you try to get greedy, you over leverage, you're going to lose. They know you're putting too much money. They're gonna take you out the market. It's easy to get people out of the market when they over leverage, right? But if you just put if you risk manage properly and you take the trade setups that present themselves, you're going to win way more than you're going to lose. Okay. I don't want to get into order blocks, imbalances, and all that good stuff. Again, today's purpose is market structure, right? But if you couple market structure with these order blocks and imbalances, you're going to be on the right side of the trade. For structure purposes, this is your structure. Can everybody see that?
Yeah.
Yes.
That's exactly what we have right now. So we got this big push down. We trade it back up into your imbalance. Push down again. We trade it back up into this order block and we push down. So maybe at some point we'll break this high. If we break this high like this, then what do we expect? We expect the market, well, but we expected to pull back first,
Yeah.
and then challenge this high, right? And maybe go into this imbalance. And then you might get some move like this. And when we break that low, that's telling you, hey man, this market is about to sell back down. So you're only watching structure on a specific time frame. I don't know what time frame that will be for you. The weekly is great enough for me. I can watch it on a super high time frame, or I can watch it on a lower time frame. I personally don't care about structure on those lower time frames because I'm always going to trade from a higher time frame. I'm going to trade from probably at least the weekly. And I know when I can take a trade in the opposite direction, and I know when the time is to take the trade with the trend. Teaching you guys, I think we're going to primarily teach you how to take a trade with the trend only. And eventually, once you get good with taking the trade with the trend, then in the main chat, you can learn how to take a counter trend trade or a substructure trade. Do I have any questions on structure?
I just have something. You said that, so the three things you need to recognize a good trade was the order block, the imbalance, and then the break of structure, and then for it to trade back up.
So the three things are order block, imbalance, and a break of structure.
Okay. All right.
And yes, you're going to look for the trade back to the imbalance. So that could be up or down. If it's a bearish order block and an imbalance, yeah, you're going to look for it to trade up. If it's a bullish order block and imbalance, you're going to look for price to trade back down into the imbalance to take the.
So basically, we always wait to pull back, and then from there, you put a trade.
Exactly. Do you know why that is? Do you know why you always wait on the pullback?
To know the direction.
Because that's when it's selling.
Confirmation.
Y'all are women, man. Y'all know why.
That's when it's selling. That's when you have. That's when it's selling.
The market pushed down. Oh no, I don't want to do it a down. I want to do an up move because y'all are women. Y'all understand this if I talk about up moves.
Want to buy cheap.
Oh yeah, my girlfriend. Look, y'all here? All right. This is price. Price pushes up here. Are y'all ever going to buy right here?
No.
Not unless your boyfriend is paying for it. Most of y'all gonna wait for price to pull back. You need a discount. You need the hookup. You're gonna buy here.
Yes.
And then you want your whatever you buy, you want it to appreciate.
Right.
This is the same thing we're doing as a group. All right. Price is gonna push up. You're gonna ask your boyfriend to buy. He's gonna be like, oh heck no. So you're gonna wait. You're gonna wait until price.
Good example.
Yeah, I love these. I love these.
And then you'll buy it and they go up. So that's all this is. And if you're selling it, it's the same thing, right? If you got you a pair of Prada shoes or whatever, you want to sell your shoes up here. You don't want price to depreciate. You're not selling them down there. Waiting until the price appreciates and you'll sell them. Right?
Yes.
and you want them to devalue, you don't care at that point, but you just want the highest price for your shoes.
Mm-hmm.
So it's all the same. You never buy high and you never sell low. You never
Okay.
sell when the price is low, and you never buy when the price is high.
Mm-hmm. Got it.
And that's it. That's in a nutshell, the basics of market structure. Now, we're just getting into this. So my plan next week is to come back and rehash and rehammer more of
Yeah.
market structure.
Yes,
Mhm.
please.
I
Yeah.
think that we need probably about 12 weeks of market structure going back
Yes.
Yes, Lord.
Yes.
Yes, Lord.
because this is one of the hardest things for
Mm.
newer traders to consume. All right. And I kind of wish that I hadn't have brought the daily. I kind of wish that we just talked about one time frame, right?
Mhm.
You got the low, you got a high, higher low, higher high, higher low, higher high, right? And I wish we didn't talk about the substructure yet, but it's cool. We got introduced to substructure,
Mm-hmm.
but when we come back next week, we're going to rehash your market structure. And then we'll kind of dive a little bit deeper in the substructure. And whenever we mark this up, like just like I drew it here, it's never going to be this clean.
Right.
Mm-hmm.
I don't know if you guys kind of caught on to what that guy said, but he was saying that, hey man, you don't have to mark every little up.
Mm-hmm.
It's not necessary to mark every little up and down when you're marking structure. You just want to mark out the basic highs and lows. So if I'm going here, I might mark this high, this low, this high,
Mm-hmm.
this low, right? This high, come back down, this low. You don't want to mark every little odd and end because that's going to be those little moves right there. They're going to be structured on the lower time frames.
Mm-hmm.
So you need a higher time frame structure that you understand, and then you need a lower time frame structure that you're going to enter to trade the substructure. Does that make sense?
Yeah.
Mhm.
Yes. He said
If
look at it as waves, right? Like
Yes,
waves.
yes, you look
Mm-hmm.
at it a wave. And if you understand this, if you understand, hey, this is the uptrend. I can look at this chart and see this is the uptrend, correct?
Mm-hmm.
Yeah.
So if you can see that, then all you're going to do is say, hey, man, when this price pulls back, right? This is the uptrend to here. When it pulled back, I can buy here and target this high.
Mm-hmm. Okay.
It's no doubt, it's no different than if I laid this across here and did this. Let me stretch this stuff out. Okay, if I had said that price came and did this, right? Higher, this is a high, higher low, higher high, and this is a pullback to this low, then you could have you say, man, this pullback, I'm buying because this is a discount, right? This is a discount. So I can buy at discount and I can target this high.
Mhm.
And price takes it and buys up. Does that make sense?
So, yes, because using that same Prada shoe analogy, so we found some Pradas, they were on sale, so we brought them down there when they were low, but we know that they normally sell for like $100 or more, so
Yes.
that's the price we targeting to get them back up at the price they normally like are valued at or whatever.
Exactly. And at this point, once price gets back up towards the area that you have them valued at, you're going to hold on to them because they might be overvalued.
Okay.
Because you
Okay.
see that the market is going up. So there's a
Right.
good chance that these shoes are going to get overvalued,
Mm,
right?
okay. Yes.
You just don't want to get caught holding the bag. You bought these
Right.
Prada shoes when they was $25. They were
Yes.
70% off.
Right.
And
Okay.
now they're up to close to value. You can take your profit, but you can also just say, you know what? I'm gonna hold on and see if
Mm-hmm.
if my homegirls like these shoes more than I do.
Right.
You know?
Mm-hmm. Okay.
So I got a question. There's a test for us. So in order for us to know that this market has shifted, it should go below the D, right? It
What do you
should,
mean below the deep? Elaborate.
oh, the D right there,
Oh, okay.
right? It should
Right.
go market should go all the way down past there. Now, should it's supposed to close below the D in
Yeah,
order for us to know it's a valid sell?
exactly. So when you say close below the D, what do you mean?
That's a higher low.
Right. But when you say close below the D, you say the market is going to close below the D.
Breaking the structure.
What does that
Breaking it. Yeah.
Oh, I'm sorry.
But what does closing below? You need a candle closure. You don't need a wick. You need
Just a
you need a full body candle closure below this low.
gotcha. Okay.
And let's talk about this too. If this is your time frame that you're watching your structure on, you need that closure to happen on this time frame.
Oh.
Not on the 1 hour.
Mm-hmm.
The 1 hour
Oh,
don't count.
wow. Oh, wow.
You need that candle to close on the 4 hour below that D.
Okay. Mm-hmm.
That makes sense?
That's great.
Yes.
Oh my goodness.
Do y'all know
That's
why? Because if a 1 hour candle closes below that D, and the next 1 hour candle is it's a bullish candle, on the 4 hour, that's just going to be a wick. You see what I'm saying?
Mm-hmm.
So it has to be on this same time frame that you get that body candle closure below. And once you get that body candle closure below, what I generally do, I will fib this move.
Uh-oh.
And it'll let me know the area I need to look for the imbalance. We don't have to do that. Like you can go and you can look and say, hey man, where is the imbalance that I need to find? Because generally speaking, when this sells, it's going to be a strong sell move and it's going to leave an imbalance. But we'll talk about that further. The main thing we need to know is this is an up trend because you're making higher highs and higher lows. There are no lows being broken.
Yeah.
When you see that low get broken, then you can say, there is my change of character, my market structure shift. And now I look for a pullback and I can sell this down and I can start targeting these swing lows.
Okay.
Mm-hmm.
That makes sense.
Yeah.
That was a great great question and a great test.
Thank you.
Okay, does anybody have any other questions?
I had a question, but it was pertaining to like pairs. And it was just something when I was just studying, I went on and did the JCP, and I'm in there studying through the university thing. The pairs and whether or not which currency comes first, does that make a difference?
Well, it does. So you have a quote pair.
Like you got up there, Great Britain pound and US dollar.
Right.
So,
so whenever you're trading that pair, if you're buying that pair, you're buying the pound, right?
Okay.
You're buying the pound. If it's going up, the pound is going up versus the dollar.
Okay.
If the dollar is getting stronger, right? If the dollar is stronger than the pound, then you got to sell GBP USD. Does that make sense? So when
Okay.
you're clicking buy and sell, you're actually clicking buy and sell for the first listed currency.
Okay. Okay. Good. Yeah. Okay. Thank you.
No problem. Any other questions?
So if GBP USD is in a uptrend, that means that you would be buying, right? You would click the buy for that.
That's correct.
Okay. Okay. Gotcha.
Any other questions?
Can we please get the video we watched, just a link in a group so we can rewatch it?
Okay, yeah, I'll do that. And I'm gonna drop another 2 videos in in the chat this week.
Awesome. Thank you.
Any other questions?
Nope, I'm feeling so empowered. Thank you so much for this.
I-
4 years of not knowing market structure. So, oh my gosh. Thank you.
You said how many years? 4 years?
Yeah, I've been taking signals, so I don't know about
Yeah,
no market
that's
structure.
true. That's true. It is um I guess it's probably very refreshing when you learn it.
Hmm.
Just don't beat yourselves up because there are many people who who still don't know it, and they've been trading for 4 years too. So the faster you learn this, the easier your trading journey will become.
I got another question, but like I said, it's just something that came up while I was studying. Um, like when you're trading, can you lose more than what's in your account and be at a deficit, like your checking account can be, like if you're overdrawn?
Well, it depends on your broker.
Okay.
Yeah, I guess you can, but
Oh, if they let you, like the ratio, if they let you go so far with being.
yeah, well, if the market moves very fast or
Hmm.
you're over leveraging,
Hmm.
everything bad that happens in trading happens when you over leverage.
Okay.
If you're not over leveraging, then that'll never happen to you.
Okay. Okay.
Um, you know, but you have to like there are ways you can protect yourself when you trade.
Hmm.
You should never lose more than you expect to lose.
Okay.
You're the one setting up your trade.
Right.
You're the one setting the risk. You're the one pressing the button or
Hmm.
getting into that trade. Your broker is never going to go into your account and put you in a trade. You're the person that's setting up all that trade information. So
Hmm.
if you are out of control, your trading account is going to be out of control.
Okay.
If you have some control, then you'll be fine.
All right. Thank you.
No problem. All right.
So we see those shoes. We see those shoes on sale.
Hey, there you go.
We only get like 2 pair. We go in and get 5 and 10
Hey,
pair. You only get
hey,
2.
that's the start of your problem. When you try to get 2 pairs instead of 1.
All right.
Thank you.
Yes. Thank you so
Bye.
much.